Hello, this is Chris with Quincy Analytics. Thanks for watching this video. Today I'd like to show a summary of a webinar that was recorded on October 30th, 2019. Quincy Analytics has partnered with Palmroll Partners in Chicago to provide banks and credit unions with a churn risk calculator. So I thought I'd give you a peek at that new technology.
So very briefly, who's Palmroll Partners? Quite simply, Palmroll Partners is an analytics and data science consulting firm. We've been around since 2013. We were founded over in London as a spin-off out of Deutsche Bank. And then briefly about Click. This sentence kind of says it all. Click is really the only end-to-end data integration and analytics platform in the world, especially in the world that's not owned by some multinational conglomerated company. Okay, so let's talk about the next scenario here. We're going to go in and we're going to predict customer churn. So again, just about every bank or credit union out there, just given the competitiveness in the marketplace, is always trying to figure out how to keep as many customers as possible, because we know it's so much more expensive to attract a new customer than it is to service an existing customer.
So once we were able to integrate that coding language back into Click, we were able to create basically a high-level overview of the churn risk, a more in-depth analysis of the churn risk based on income groups, and a risk calculator, which would be mainly used for ad hoc analysis. And this is the churn risk calculator. So there will be a lot of times when there will be the need for ad hoc analysis, or you're meeting with a potential new client, so you don't have all their data stored, but you're getting that data as you talk to them. So this will allow you to, put in different values into the fields that were significant, and then it will spit out the likelihood that the customer will leave or stay and the risk associated with that. So we can see here, the only difference between the values in the fields is income, where it's 100 for the first calculator and 150 for the second calculator. And there's a huge difference with the risk associated with that.
Yeah, that $50,000 difference makes a massive difference in that likelihood, doesn't it?
Definitely. So if we look at education and we just change that to 3, this is all live, we can see that the likelihood went down to a 20%. So a 3 just means that this customer had a postgraduate degree. So we can see that made a huge difference. So this can be used to get down data and kind of understand if a potential new client will stay or not. It will be good for kind of scenario analysis, comparing different scenarios and seeing the likelihood that they'll stay or leave. And so, yeah, there's a couple ways that this can make an impact in your organization.
These models are done specific to your bank or your credit union with your customers, and can give you great insights on how to service that specific set of data. So this is great. Thank you, Dom. And then finally, I want to thank a couple of our partners that have helped us out with this. Quincy Analytics, Chris and his team, and Data Robot for the capabilities that they offer up through their platform as well. So with that, if there's any other follow-up or questions, you've got my contact information there on the screen. And with that, I want to just say thank you so much for participating in this, and we hope to get a chance to talk with you very soon. Thanks, everyone, and have a great rest of your day.